Um, Let me tell you about my friend Sarah. 32 years old, good job, saves money every month, does everything right. Last year, she finally bought a house. Everyone congratulated her. Her parents were thrilled. She posted the keys on Instagram with some caption about finally building equity instead of throwing money away on rent. Here's the thing, 6 months later, she's sitting at her kitchen table doing math she wishes she'd done before signing anything. Property taxes went up. The water heater died, $1,100, gone. HOA fees she didn't budget for. And when she actually calculated what she was paying per month compared to her old rental, including the stuff nobody warns you about, she was paying almost 40% more to live in the exact same square footage. That's not a story about Sarah making a bad decision. That's a story about almost everyone getting sold a myth, the myth that renting is throwing money away, and buying is always the smart, grown-up, responsible thing to do. Look, I'm not here to tell you renting is better, and I'm not here to tell you buying is better. I'm here to tell you that the way most people compare the two is broken, and once you see the real math, you're going to look at your own housing situation completely differently. So let's actually dig into this because the answer might surprise you. It did for me. First, let's talk about where this renting is throwing money away idea even comes from. It's been repeated so many times by parents, by real estate agents, by that one uncle at Thanksgiving, that it just feels true. But here's a stat that should stop you in your tracks. Federal Reserve data on household wealth shows homeowners in the U.S. have a median net worth around $250,000, while renters sit at around $6,000. That's a 40 times difference. Sounds like a slam dunk for buying, right? Case closed. Go buy a house? Not so fast. Here's the uncomfortable part almost nobody talks about. That gap isn't proof that buying makes you rich. It's mostly proof that people who already have money buy homes, and people who are struggling financially rent, often because they have no other choice. Homeownership doesn't create wealth out of thin air. Wealthy people become homeowners, and then that outcome gets reported as if it were the cause. That's called a correlation-causation trap, and it fools smart people every single day. So if the stat is misleading, how do you actually figure out which one is better for you? Think of it like this. Renting and buying aren't good or bad. They're just two different financial vehicles, like a bicycle and a car. Ask which one is better without context, and it's a meaningless question. Ask, which one gets me to my destination fastest, cheapest, with the least stress? And now we're talking. The house isn't a wealth machine, it's a leveraged, illiquid, high-maintenance asset that happens to also be where you sleep, and once you see it that way, the whole conversation changes. Let's break down the real cost of buying, because the sticker price is just the beginning. Say you buy a $400,000 home. Most people focus on the mortgage payment and stop there. But add it up, property taxes, roughly 1 to 2% of the home's value every year, that's $4,000 to $8,000 annually just in taxes. Homeowners insurance, another $1,500 to $2,000 a year. Maintenance, and this is the one people always underestimate, financial experts recommend budgeting 1 to 2% of your home's value per year for repairs and upkeep. That's $4,000 to $8,000 every single year, whether you spend it or not, because eventually the roof, the HVAC, the water heater, they all fail at once, usually the same year. Then there's the buying and selling costs. Closing costs when you purchase run 2 to 5% of the loan. And if you sell within a few years, realtor commissions alone can eat 5 to 6% of the sale price. That's $24,000 on a $400,000 home, just to hand someone the keys. Now here's the reveal that changes everything. In the early years of a mortgage, the vast majority of your payment isn't even building equity, it's interest. On a 30-year mortgage at today's rates, in year 1 you might pay around 80% of every payment straight to the bank as interest, only 20% chips away at what you actually own. People think they're building equity from day one. They're not. They're renting from the bank at a much higher price and calling it ownership. Now let's flip to renting, because renting has its own myth to bust too. Yes, when you rent, none of that money comes back to you, that part's true. But here's what renting gives you that buying doesn't. Flexibility, predictability, and, this is the part that blows people's minds, the opportunity cost advantage. Here's what I mean. Say buying costs you $3,000 a month all in, and renting the equivalent place costs you $2,000. That $1,000 difference doesn't have to just disappear. If you actually take that difference and invest it consistently in a simple low-cost index fund, historically averaging around 7% annual returns after inflation, that gap can grow into serious money over time. This is the part real estate agents never mention, because there's no commission in telling you to open a brokerage account instead of buying a house. This comparison even has a name economists use. It's called rent versus buy analysis, and the tool that does it best is something called the price-to-rent ratio. You take the price of a home and divide it by the annual rent of a similar property. Under 15, buying tends to make more sense. Over 20, renting usually wins mathematically. In cities like San Francisco or New York, that ratio can be 30, 40, even higher. That means you'd need to stay in that home for 15 plus years just to break even compared to renting and investing the difference. In cheaper markets across the Midwest, that ratio might be 10 or 12, and buying starts looking a lot smarter. So the real answer, the one nobody wants to hear because it's not a catchy headline, is it depends on your market, your timeline, and your behavior. And that last one, your behavior, is honestly the biggest variable of all. Here's the thing, the invest the difference strategy only works if you actually invest the difference. And I need to be honest with you, most people don't. They rent for less, and then that extra money just evaporates into dinners out, a nicer car, subscriptions they forgot about. Research on saving behavior consistently shows that money not automatically directed somewhere tends to just get spent. It doesn't sit around patiently waiting to become an investment. So if you're the kind of person who will actually set up an automatic transfer to an index fund every single month and never touch it, renting and investing can genuinely outperform buying, especially in expensive cities. But if you're the kind of person who needs forced savings, who needs that mortgage payment as a discipline mechanism because otherwise the money just disappears, then buying might be the better vehicle for you, not because the math is better, but because the behavioral outcome is better. And that's a completely valid, completely rational reason to buy a home. Personal finance is called personal for a reason. It's not just a spreadsheet, it's psychology. Let's talk timeline too, because this might be the single biggest factor in the entire decision. Buying a home comes with massive upfront transaction costs, that 5 to 8% you pay just to buy and later sell. If you're not planning to stay in a home for at least 5 to 7 years, the math almost never works in favor of buying. You simply don't have enough time for appreciation and equity building to outrun those transaction costs. Some finance creators call this the 5-year rule, and it's one of the most useful, boringly simple filters you can apply before you even start looking at listings. Now let's get practical because I promised you actionable advice, not just theory. Here's how to actually run this decision for yourself. Step 1. Calculate your true price-to-rent ratio. Find a home you'd realistically buy, find a comparable rental nearby, divide the home price by the annual rent. Write that number down. Step 2. Be honest about your timeline. If there's any real chance you'll move for a job, a relationship, or just life in general within 5 years, lean hard toward renting no matter how good the house looks online. Step 3. Calculate the full cost of ownership, not just the mortgage. Add taxes, insurance, maintenance at 1 to 2% of home value annually, and don't forget closing costs on both ends. Step 4, and this is the one people skip, look yourself in the mirror and ask honestly. If I rent and save the difference, will I actually invest it or will it disappear? There's no shame in the answer either way, just be honest, because the whole strategy depends on it. Step 5, remember that buying isn't just financial, it's also about stability for your family, your mental health, your sense of control over your space. Those things matter and they're allowed to factor into the decision. Just don't let them disguise themselves as financial arguments when they're really emotional ones. Separate the two clearly in your head. Let me bring this back to Sarah because her story actually has a second half. After that rough first year, she didn't panic and sell. She sat down and actually ran these numbers properly. Turned out her price-to-rent ratio was around 14, right on the edge, and she was planning to stay in that city for at least 8 more years for her job. Once she factored in her full timeline and accepted the maintenance costs as a real, planned expense instead of a shock, the math actually did work out in her favor, just not nearly as dramatically as she thought going in. The lesson wasn't buying was a mistake. The lesson was that she made the decision with incomplete information and got lucky that the fundamentals still lined up. Not everyone will be that lucky. That's the whole point of this video. Buying isn't automatically smart, and renting isn't automatically wasteful. The people who win long-term, whichever path they choose, are the ones who actually ran the numbers instead of just following what their parents or their real estate agent told them was responsible. So here's what I want you to do. Don't just nod along and move on to the next video. Open a calculator right now, find your local price-to-rent ratio, be honest about how long you're actually staying put, and be honest about whether you'll invest the difference if you rent. That 15 minutes of uncomfortable math could genuinely be worth tens of thousands of dollars over the next decade. And that's not an exaggeration, that's just what compounding and interest actually do over time. The house you live in isn't going to make you wealthy just because you own it. Your decisions, made with real numbers instead of real estate slogans, are what make you wealthy. So run the math, know your timeline, know yourself, and then make the choice that actually works for your life, not the one that just sounds good at a dinner party. If this helped you see the decision differently, that's exactly what it's here for. Now go do the math before you sign anything.